There's a trap that early retirees fall into that can cause healthcare premiums to cost as much as $24,000 a year. And many smart retirees that I speak to find themselves paralyzed, unable to pull the trigger on a retirement that they can afford until they hit Medicare age because of fear of those pre-Medicare healthcare costs. But with the proper planning, pre-Medicare healthcare premiums could cost you next to nothing. And the difference comes down to one number that I call your flexibility ratio. That number allows early retirees to ignore pre-Medicare health insurance costs and focus on enjoying their early retirement. So let me show you what I mean. Here's what nobody tells you about early retirement healthcare. Your premiums aren't based on how much you spend. They're based on how much income you show to the IRS. And whether you can control that income is what your flexibility ratio measures. Now, I had a client who retired at 60, a really sharp guy, and he had $1.8 million saved. He wanted to spend $120,000 a year in retirement, but he didn't understand the flexibility ratio. And as a result, his pre-Medicare health insurance premiums ended up costing him almost $2,000 a month. Now, over 5 years until Medicare kicked in, for this gentleman, that added up to $117,000 in healthcare costs. Then I showed him how to calculate his ratio and adjust one thing. And he kept spending the same amount of money. He maintained the same lifestyle, but his premiums dropped to $330 a month. Now, that change saved him almost $97,000 over 5 years. And so I'm going to show you the trap and then how to calculate your flexibility ratio and the one mistake that destroys everything. So let's talk about the trap first. So on the screen here is a visual of how the ACA health insurance premium actually works for a married couple. See this line here where it says $84,100? That's the threshold where everything changes for retirees. That is a number that is 400% of the federal poverty level. Now, below that number, your health insurance premiums are subsidized and capped. Above that number, you pay full price with no subsidies at all. So watch what happens. At $84,000 of income, a 60-year-old couple pays about $331 per month. At $85,500 of income, right? Just $1,100 more, they pay $1,950 per month for health insurance. So if you cross that line, your premiums jump by $1,600 a month, which ends up being $19,000 a year, which is almost $100,000 over 5 years. So this is what we call the subsidy cliff. And you can see it on the screen right now. Most retirees walk right off of it without even knowing it exists. So the question is, what pushes someone over that cliff? Well, the first item is claiming Social Security too early, right? Social Security checks add tens of thousands of dollars to your adjusted gross income every single year, whether you actually need that money or not. The second item is going to be having too much money in traditional IRAs. If all your money is locked up in pre-tax accounts, traditional IRAs in this case, then every single dollar you withdraw counts as adjusted gross income and pushes you further above that cliff. The third item are pensions, which kick in automatically. Pensions are fixed income sources that start flowing whether you want them or not. Sometimes you have some choice over the age you claim at, but if you don't, then they're going to start kicking in and pushing your income above those cliffs. The fourth option or fourth item are dividends and interest that you can't turn off. Right? Those are investment income sources that keep flowing and you're taxed on in the present year, no matter what. And then the fifth item is using the wrong withdrawal sequence. And the wrong withdrawal sequence refers to pulling from the wrong accounts in the wrong order in such a way that they cause your taxable income, according to the IRS, to push above that cliff threshold. Now, all of these things lock in your income at a level that you can't control. And once your income is locked in at that level, your premiums end up locked in as well. But here's what's interesting. Some retirees have all the right pieces in place, and then they still end up getting penalized by those premiums. I'm going to show you why in just a minute, but first let's look through a case. So let me show you two couples. Both are 60 years old and both are spending $120,000 a year in retirement. Now, couple A has all of their money in traditional IRAs, and so they pull everything from those pre-tax accounts because that's where all their assets are. Traditional, in this case, they pull $120,000 from their IRA and their income, according to the IRS, is $120,000. They end up with a gross premium for their health insurance premiums prior to Medicare of $1,950 per month. They get no subsidy because they are above the $84,000, roughly $84,000 cliff, and they end up with a net cost of $23,400 per year for their health insurance. Now, they're way over the subsidy cliff, so they get no help at all. Now, couple B, on the other hand, has their money spread across different account types. Watch what they do. They withdraw $60,000 from an IRA. All $60,000 of that counts as adjusted gross income according to the IRS. They then do a $20,000 withdrawal from a Roth IRA, which does not count towards their income. They then withdraw $20,000 from cash, which again does not count towards income. And then they harvest $20,000 of long-term capital gains from an after-tax account, which does count as income. They end up with total spending money of $120,000, but their income, according to the IRS, is $80,000. So they're spending the exact same $120K as couple A, but they only show $80,000 in income, and therefore they end up with gross premiums of $1,950 a month, but they end up with a subsidy of $1,620 a month. And then they end up with a net cost, meaning their out the door cost for the health insurance is going to be $3,972 a year. So couple A pays $23,400 a year, couple B pays $3,972 a year. That's a difference of $97,140 over 5 years. So what's the real difference between these couples? The difference is what I call their flexibility ratio. So here's the formula on screen. Your flexibility ratio is equal to your Roth money plus your taxable basis plus your cash divided by your total assets. So you take your three sources of funds that don't count as income when you withdraw them, and you divide that by your total financial assets. So let me explain what I mean by taxable basis. The taxable basis is your original money that you put into your taxable brokerage account. So it's the principal that you already paid taxes on when you earned it. When you withdraw that basis, it doesn't count as new income. Only the gains on top of that basis count. So let's use an example really quickly. Say you have a $1.2 million saved and it's split as follows. $500,000 in a traditional IRA, $300,000 in a Roth IRA, and $400,000 in the taxable brokerage account, $250,000 of which is in basis. So $300,000 is the Roth IRA. You're going to add $250,000 of your taxable basis, and this couple has no cash, so we're going to add $0 of cash. That then gets divided into $1.2 million, resulting in a flexibility ratio of 46%. The 46% flexibility ratio means that nearly half of your money doesn't force income according to the IRS when you withdraw it. So you can control what you show to the IRS. Now compare that to someone with most of their money locked in traditional IRAs, which is going to look like the second example here. So they have only $200,000 in Roth money. They have no taxable basis and no cash. So that $200K of Roth money gets divided into $1.2 million of total savings, ending up with a flexibility ratio of 17%. A 17% flexibility ratio will indicate that you're pretty much trapped. Most of your money forces income according to the IRS, whether you want to show it or not. So you're going to have very little control. So here's how the different ratios play out. If you have a high flexibility ratio and you want high spending, then you have some ways to optimize. If you have a high flexibility ratio, but low spending, you have the most control and will end up with the lowest amount of health insurance premiums. If you have a low flexibility ratio, but you have low spending, you're going to have some mixed results that are manageable, but you're going to have limited options. And if you have a low flexibility ratio, but high spending, you're going to end up being forced to pay full health insurance premiums before Medicare. Now, here's what trips people up. You can have a perfect flexibility ratio and still blow your health insurance premium costs completely. So I had a couple come to me last year. They were both 58 years old and wanted to retire immediately. Their portfolio was comprised beautifully. They had a 65% flexibility ratio, right? Plenty of money intentionally put into Roth accounts, plenty of money in taxable basis, and plenty of money in cash. When we ran the numbers, we found that they could spend $110,000 per year and show only $55,000 in income. And as a result, they would pay $412 per month for both partners' health insurance premiums until Medicare. It was a perfect plan. But then they made a decision that really kind of screwed things up, right? They claimed Social Security early at 62. So here's what happened. Those Social Security checks added $38,000 a year to their household income. And their MAGI, their modified adjusted gross income, which is what the IRS cares about in this case, jumped from $55,000 a year to $93,000 a year, blowing them past the subsidy cliff. Their premiums went from $412 per month to $1,950 a month overnight. That one decision cost them $18,000 per year for the next 3 years until Medicare kicked in. So that's roughly $54,000 in additional health insurance premiums that they did not have to pay if they had simply not made that choice. Now, here's the worst part. They couldn't undo it. By the time they had come to meet with me, they had already been on Social Security for a year, and you cannot unclaim Social Security after the first 12 months. So even if you have a high flexibility ratio, you can still trigger this trap with an irreversible decision. That's what I need to show you how to avoid. So let me walk you through how couple B from earlier actually executes their year-by-year strategy to actually stay beneath that federal poverty line cliff. So couple B is 60 years old and they won't claim Social Security till 65. So they have 5 years to plan for this. In the first year, they need $120,000 to live on, and so they pull $60,000 from a traditional IRA, which counts as income. Then they pull $20,000 from their Roth IRA. That's money they've already paid taxes on when they converted it or contributed it to it. That doesn't count as income. They then pull $20,000 in cash from their cash savings, and this is money that's already been taxed. And then they realize $20,000 in long-term gains from selling some appreciated stock in their brokerage account, which does count towards income. They end up with total spending money of $120K. Their total income shown to the IRS is $80K. And this is where people make mistakes, right? They pull too much from their traditional IRA and blow past the cliff without realizing it, or they don't pay attention to taxable interest or dividends from bank accounts, which is money that they don't actually end up spending, but still gets taxed and contributes to your taxable income in the year that it happens. And this ends up blowing them past that $84,600 cliff and ruining their ability to be eligible for these subsidized health insurance premiums. In this case, couple B knew to avoid those things, and so they end up with just $80,000 of taxable income, and they end up with subsidized healthcare premiums, and they rinse and repeat this strategy each year from 60 to 64. And at 65, Medicare kicks in, the game changes entirely, they can claim Social Security, they have a much higher level of wiggle room with which to manage their modified adjusted gross income, so that they don't end up paying IRMAA surcharges. The IRMAA surcharge cliff is in the $200,000 range for a married couple, so they had a lot more wiggle room and did not have to be as detailed about their withdrawal sequencing. But here's the critical part of all of this. You have to really start this process before you claim Social Security or a pension. Once you have those guaranteed income sources kick in, they're going to add income and they're going to reduce your flexibility. And if you have a low flexibility ratio, you simply might have no options when it comes to affordable health insurance before Medicare. And so putting all this together, when you end up saving $10,000 or $20,000 a year on health insurance premiums, it's not just money, although the money is extremely meaningful. It's also freedom, right? Spending money at 60 or 62 means a lot more than spending money at 85. At 62, we're talking about that money going towards a 3-week trip, a 3-week walking trip in Italy, or flying your grandkids out and taking them to Disneyland. Whereas at 85, you might have more money in the bank, but you cannot use it for those types of things. And you really can't buy back the mobility or experiences that you could have had at 62. And so the question here isn't whether healthcare is expensive. The question is, what's your flexibility ratio? And are you about to trigger these health insurance premium traps without knowing it? So if you're watching this video and you're wondering whether your own retirement savings can support the life that you want, click the first link in the description below this video to watch a free webinar that I've recorded that describes the 4-step system we use at Peak Financial Planning to help you craft your dream retirement. Thank you as always for your time and attention in this video. I'll see you in the next one.